Welcome to the Festival of Entrepreneurs, recorded live at the NEC in Birmingham. Over the next few minutes, you'll hear from some of the most incredible founders, investors, and business leaders who joined us this year.
So what we're going to unpick is kind of understanding debt finance, and for any of the kind of other lending sessions that people were on this morning, one of the things we're unpicking is there's lots of different lending products out there. So as business owners, it can be quite challenging to understand what business product or what lending product is right for me. So we've got a great panel here from a range of different debt funding providers. We've got Paul Warrington from Lloyds, Nick Baker from Alica, and Oliver Dean from Money. So I'm going to get the guys to introduce themselves, the background, and also what their bank or fund does as well. So Oliver, do you want to kick things off?
Hi, yeah, great to be here today. Thanks for the invite. So Money is we're a specialty financer. We're much smaller than these guys here, but we focus on invoice factoring. So essentially, when a business has receivables which the cash is not yet arrived for, we will finance that bridge. We focus specifically on the creative media industry. So we work often with production companies who are making media content for YouTube or Netflix or Channel 4. People else?
I'm going to call it the mic instructor. You've got Nick Baker, I'm Chief Commercial Officer at Alica Bank. I've been working with SMEs for about 20 years. I work for a bank now, which is very much the dark side. But before that, I spent 15 years working in brokerage, where I was finance broker supporting SMEs, predominantly for trading businesses, so owner-occupied, real estate, asset finance, bridging finance, so heavily property-based. But the last 7 years, I've been working at Alica Bank, so I joined the bank free license. We got our banking license in 2019. We're now 800 colleagues, solely focused on established SMEs. Have lent about £4 billion, and about the same, a little bit more than that on deposit, with 800 colleagues now across the UK and India.
Hi everyone, hopefully you can hear me. Brilliant. I've got to say hi to everyone else, so good to forgive me. Yeah, Paul Warrington from Lloyds Bank, Relations Director, worked in banking 23 years. I lead on tech in the Midlands, anything from pre-revenue up to 100 million turnover. I also look after every type of business you can imagine. I used to work in credit as well, so I've got that badge and all the good things that that's brought with it. But I'm just delighted to be here. So.
Super. Thanks so much, guys, for introducing yourselves. So one thing that I want to dig into straight away is around securitization. So when you're going to look for debt financing, obviously you're looking into getting that capital in, but sometimes business owners can get intimidated, or they don't understand when it comes to security. Do they need to give a personal guarantee? Do they need to put up forms of assets? So I'm just curious to kind of unpick your various different products when it comes to security, and how a business owner should think about what they need to think about when it comes to taking out any kind of security with the kind of products that you offer. Paul, if I might start with you, if that's okay.
Yeah, absolutely. So the first thing I'd say about offering any bank or financial institution security is think very carefully about that. It's a secured lend, and that comes with real responsibilities. I'm very proud over the last 23 years that very rarely have we ever, in my customer base anyway, had to repossess someone's home or commercial premises. Very, very proud of that. But on occasions it does happen, so I think be cautious would be my first thing. I think with regard to security, it does give the option of having a much cheaper loan than an unsecured facility. But also don't lose sight of the fact that there's personal security and there's also business security. And I would always say go to the business security first. So that can be the customers that you've got that owe you money. So piggybacking their credit ratings, and the bank can lend through a facility called invoice discounting. Start off with that. Offer the bank a debenture, which is a charge over those books, debtor books, and also other assets in the business. Always maximise secured lending on the business first, and think very carefully about offering it from a personal point of view. That would be my advice.
Super. Nick, do you want to go next?
Yeah, I just add that, yeah, I mean, that's such an important point. There's been real horror stories about how entrepreneurs, how businesses have been treated when the crunch comes, and that crunch hits all with many different forms of the actual crunch all the way through to other challenges that many of us here have faced. So always, that is the caveat to keep in mind. That's the number one thing to take away in that respect. What I would add is, you guys understand as much, if not more, than us lenders about risk and reward than we do. And I would just look at each opportunity as it arises. You might, as entrepreneurs, come across some opportunities where actually a longer tail, they come with more predictable cash flows, and that might suit itself to a more secured opportunity. On the other hand, you might have the opportunity for what in old money we would have called a quick turn. And if there's a quick turn, then perhaps you can take a different view on the type of facility you might get. So I would trust your instincts there on risk versus reward, and especially on the unsecured side, especially unsecured. Engage with Swoop, engage with brokerages that can help to navigate that market. Having been a broker, I know the market is as diverse as it has been. The National Association of Finance Brokers has got 200 lenders, members of that trade association, and that is less than a third of the market, comfortably less than a third of the market. So do engage that broker and have them as part of that deal team, that expert advisory team that you've got, and then make a decision on that basis.
Yep, I'll leave you with this.
Well, tough act to follow. I think you guys have covered pretty much everything. But I could talk a little bit about what invoice factoring businesses are interested in. So for ourselves, we very rarely look for a personal guarantee. We're not interested in that. We are taking security over the invoices, as was so well put. Essentially, that allows our customers to piggyback on the creditworthiness of their customers. So ultimately, we're lending against an invoice to Netflix. Netflix is, they're going to pay. So, it allows us to extend credit to businesses at rates which they might not otherwise be able to get.
Super. So I kind of want to dig into some of the misconceptions sometimes around debt. So before this, I don't know if any of you were here, but we were chatting about equity financing, and people get very attracted, business owners get very starstruck when it comes to equity financing, so much so that they can be sometimes dismissive or not quite understanding what debt financing is and the opportunities that it offers. So I'm just curious to kind of unpick from you guys, like, what you see sometimes as like people's misunderstandings when it comes to debt financing. Is there areas that you might want to clarify and go into vis-a-vis other funding products? Nick, I could see you ready to go there. So
that's my I'm still so cynical, having been a broker, and I can't quite get my head around. I've got a colleague in the corner who's to block his ears. I'm still not a banker. It's just never happened. I just happen to be employed by a bank. So I'll use an example if I can. We're often told that the computer says no, and we're often told that it's only the numbers that matter. But a couple of things. I hate to break it to you, but profits and cash flow are really, really important. We're very, very good at lending money, and perhaps we're very, very good to get it back. I mean, you guys, we have shareholders and other interested parties. But there's a misconception that it's all numbers, and it's not. Increasingly, without doubt, we must understand the story behind. So I can guarantee you that today we will decline a business that wants to borrow money. Don't have a 100% approval rate. We'll decline it when the numbers make perfect sense. When the debt's affordable, sensibly geared, sensible people that know what they're doing. Because we don't understand part of the story. Perhaps that was some trading struggles that they had before. Perhaps that was a contract that they lost, a new contract that they've won. And very often, that is not explained to us in anywhere near the amount of detail that we need to understand to lend money. So I would absolutely say your stories matter, and they really matter. So a quick example if I can. The very first transaction we did closed on the day we shut the office for COVID, and it was a wedding venue. And we lent the money, and I remember because I pressed the button, but they nicked us our first deal. That customer told us their story. They told us what they were going to do, they told us how they could go to work, they told us how they could get other income streams. We understood the transaction. That case doesn't happen without a story, so it is not just about numbers, and really be great storytellers, as you often are with your customers. do that with your banks and your lenders and your other partners as well.
Guys, anything else you'd like to add to that?
Yeah, I think one of the biggest misconceptions over the last 50 years, and I had exactly the same scenario yesterday, is around what we were talking about just a minute ago, which was invoice discounting. There's a dirty word called factoring, and if you've been in business for more than 10, 15 years, you will have heard of that. Factoring generally, a lot of businesses don't do it anymore. We don't do it anymore. We've just come out of that market. It's confidential invoice discounting. It's effectively a secured overdraft, and your clients don't actually see that you're borrowing from us. So when I talk to smaller businesses, they often think, oh, that's a bad thing, invoice discounting. And I say to them, well, yeah, you might be turning over 5 million. Businesses in your sector turning over more than 25 million, some of which I deal with, it's almost 90% full invoice discount, because they know the value of those business assets, in fact, to that security versus unsecured. So they're borrowing really cheaply for a very flexible facility. And if I called it an overdraft or a secured overdraft, everybody would want one. Just because we call it invoice discount, it's got that link to factoring, everyone switches up straight away. I think the other thing I would say is, it goes back to what you just said about that backyard, is a lot of what we do is we try and understand the journey of that business in the past, but more importantly going forward. And it's being able to articulate that and what, be honest, where are you in that journey? We talk about the life cycle of business, where things are going really well and then you have a bit of a dip and then you have to pick on again. Talk about the dips as well as the ups. What have you learned from those dips? What have you done differently? Maybe you brought somebody in, maybe you went to night school to learn a bit more about finance or whatever it might be. Share that experience, because we are really interested in that, because businesses that have gone through that will be stronger businesses than those who haven't. They do share that story.
Thanks, Paul. Oliver?
We're supposed to be, I forget your question, but we're supposed to be beating up on equity raising, right?
Yeah, pretty much that. Do you want to take that on?
Yeah. So I, in a previous life, I had a VC-backed business, and equity raising is really good at the beginning when you essentially, your future cash flows are extremely, opaque, as we say, and that, in that case, it's very hard for a debt financer to securely lending into a business. But once you get going and once you've got predictable cash flows coming in, you've got a customer base, debt financing is almost certainly going to be the cheaper option, and probably, you're going to be giving up less of your business. And ultimately, debt is a great way to, increase the returns on your business, because you actually can, gear your business up, you can leverage it to get greater returns for yourself as the equity owner.
I think that's just so important, because I think, again, similar to what we were saying at the beginning of the question, so many business owners are just so fixated on that equity check that actually not taking the time out to understand debt financing and all the products that live underneath it and how they can be leveraged. You don't always have to go down there, but actually understanding it, unpicking them and working them through to the businesses can give you a really good comparative as a business owner to see what is the right fit for you. And I suppose kind of digging into that kind of future thinking perspective, I think you massively touched on it in terms of the importance of the human and the story aspect. And yes, we want to see good financials, we want to see good profitability, like any lender. How important is the future aspect too, in terms of how you assess current affordability versus what they're forecasting to do? How important is that forecast element into businesses that you're assessing?
I think it's how the operator, the borrower, the customer has gone about thinking about the forecast as much as it is the actual forecast. So through that forecasting activity, of course we want to see that the endpoint is something that shows a sustainable business without knife-edge gearing, that's got sensible headroom, that's ultimately going to give the operator a return. Guess what? They don't have a return very often. We don't take the keys, they get given factors. So we want to make sure there's enough in it. But for me, I will always go back to how are people going about putting these things together? What assumption are they using? What's their team that's helped us? Have they gone to night school, for example, but how are they thinking about their business over the years? How are they thinking about the risks it's going to face, and how are they thinking about mitigating them? So I think it'd probably be as much, again, the story of the constituent parts as it would be the number if we go out the end, because surprise, surprise, most projections and forecasts, and I'm doing this at the moment for my boss because it's budget time, so don't tell him, but most projections, forecasts and budgets will broadly end up on the number they need to end up on. It's in 3, 4, 5 years time we see what's really happened. So have we got the right characters behind it that are going to go through hell and high water to get the number to where they thought it was going to be?
Oliver, I don't know, do you, with Monet, do you take into account kind of how the business is growing, or is it kind of very much focused just on the receivable side of things, or how do you assess the business as a whole?
Yeah, I mean, we obviously, the risk in our business is twofold, which is firstly the ultimate creditor, so whoever that invoice is going to defaults. So that is very important to us. And then beyond that, we're obviously worried about the person we're essentially lending money to. And frankly, the biggest risk we face there is fraud. So what we do is we're not, because we're taking security over an invoice, we're not as worried as someone who'd be giving you a term loan, for example, would be worried about, that particular, business and its future beyond the lifetime of the invoice we're buying. So for us, we're really just checking to make sure the business is run well, are the accounts, done on time, that sort of stuff. Does the budgeting, make sense? Is the business owner not using it as their personal credit card? Stuff like that. Because we want to make sure that when that invoice is finally settled by the ultimate creditor, we are going to be the recipients for those funds.
Paul, if I can kind of augment the question slightly, from a Lloyd's perspective, when you think about kind of the future, because a lot of this is kind of assessing the applicant, funding of, how do you keep an ongoing relationship with a business? Like what is your involvement post-funding? How does that look like?
Yeah, Lloyd's are really proud to be relationship bank, relationship managers, and I'm a relationship director. So the forecasts are really valuable, but they're only as valuable as the business owner presented it. It's the business owner doesn't know those numbers, say, what's up on the cabinet. And sometimes, if that's not a strong point of yours, then be honest about that and bring somebody in who is. There's so much flexibility, a lot more than what there used to be now. You can bring somebody one day a month just to help you on that. But in terms of, from our point of view, if we're looking at projection, we're going to look at them as a relationship team on a regular basis. It's not going to be a one-off event. So, just make sure that what you predict to us is realistic. I would always suggest there's about 2 budgets. There's got to be your worst case budget and your best case budget, and hopefully you'll land somewhere in between, and maybe the best case. But be prepared to talk about those numbers, and it seems full circle to what I said before. And it's when things go right on those numbers, be able to articulate the profit if you made, that extra profit, but also why. And likewise, when it doesn't go so well, articulate maybe that loss and why that is, what you can do about it.
Yeah, so just digging into that last point, like not everything is always rosy and has those hockey sticks. So where have you seen kind of good behaviour from business owners that obviously when they get the loan documents at the beginning it can be intimidating because it's like, God, how many pages there? They're probably impatient, just want the money, so they're maybe not reading everything. So how have you seen kind of good behaviour when things go wrong to kind of help them address where they should be thinking vis-a-vis covenants or readdressing where the growth hasn't been? Like what's the good behaviour that you look for in that situation?
I think honesty is absolutely vital, being honest about the situation. Ideally, try not to enter that position in the first place. So, we had a conversation this week with a business that we're bringing on board, the bank, and they're good sector, good management team. Guess what? One of the first things they were talking about was covenants, not the price. So they know what they're doing, and the reason they did that was because they knew that 25's accounts would miss that covenant. And so they had that honest conversation, and we said, yeah, we know you're going to miss the covenant on 25's accounts, but we're going to position that with our credit team accordingly. So we're going to agree that we're going to start testing those covenants on 26 accounts. And for that was because they know the numbers, they've got a budget, they've got that regular management application.
It's such a fascinating insight. It actually came up this morning when we were running sessions, this idea of transparency and honesty. And again, funding can be intimidating for business owners, but what we're hearing time and time again is if you go in super transparent, you build a much stronger relationship with the bank or the lender or the alternative funders. Is that your experience, I suppose?
Yeah, the old saying of the bank will only lend you an umbrella when it's already raining. What works really, really well is if we're all looking at the weather forecast, we will lend you an umbrella just before it starts to rain if you tell us that it's going to rain. Because we don't want to put a business into what, in banking terms, we would call stage 1, stage 2, stage 3, different levels of distress and default. That's not a good look for anyone. It's a really not a good look. Yeah, if you say, Nick, Paul, whoever you're, Alan, who we've got Malak in the corner there, as your relationship manager, I'm forecasting forward here, and I can see, I'm a seasonal business or I'm not a seasonal business, but I can see 4 to 6 weeks time, I've got a 4 to 6 weeks cash flow pinch. That can be dealt with, and that can be dealt with so rapidly. The alternative is hard to deal with and is never dealt with rapidly, and will hopefully end up in a property instance, in a consensual sale or something that people really don't want to get involved with. Yet if you talk to us, we're as keen for that debt to go bad as you are, which is 0.
Oliver, we were kind of just chatting just before this about how hard it is for business owners to truly understand how many products are out there. Nick, you obviously touched on the NACFB represents 200 lenders, of which you say is only a third of the actual market. How do you find the challenge in terms of getting awareness to business owners about the other products, particularly your own, and how have you kind of seen SME landscape change over the last few years?
Yeah, I mean, there's I have a different business on the side, right? And I log into my digital banking app, and I think I have Funding Circle, maybe even Alaka, like you kind of get like 5 different opportunities to borrow some money. And I think it can be very, very easy to choose the wrong product because there's some really quick, products out there you can take really quickly, but I can guarantee they're probably not, in most cases, going to be the best product for everyone. I think with any lending product, right, you're kind of considering 2 different things. You're considering the risk to you and the cost, and you want to think very carefully about what exactly you're looking for. Because there's so many lenders out there, there's so many products, you can probably find your perfect product, particularly if you go to someone like Swoop, who's going to send you in the right direction. So we often come across companies who we think would be a really good fit for us, but they've already got an existing term loan on the book with a first-ranking debenture. At that point, there's a bit of a difficult conversation with us, with the other lender, to say, hey, the business would like to carve out certain receivables to basically discount them with us. Now, some people who give term loans are happy to do that because they want to avoid a cash crunch, actually, and they're going, hey, it'd be better that this company, can take on a little bit more debt so I can continue to get paid. But not all lenders are willing to do that. So I think you have to be really careful, and I think you definitely need to work with people like yourselves to find the best product.
Just curious, for both of yourselves, you've obviously had a huge amount of experience. Nick, both on the broker and the lender side, Paul, obviously massive experience through Lloyd's in terms of the changing landscape. But it does certainly feel that over the last 8 to 10, it's really accelerated in terms of the volume of products, volume of lenders. Just so really curious to just get your sense on it.
Yeah, there's a disturbing other side to it though. So here we go, bear with me for a second. There's more choice than ever. There's more lenders than ever. There's more entrepreneurs than ever, based on any number that you look at. Yet, in this country, we have the lowest SME loan application rate of anyone in the OECD. Anyone. And we also have the lowest business investment rate of any country in the G7. So something's still going awry. That's perhaps something to think about. You may have a view on that. Fundamentally today, if I was shopping the market, what would I do? I would shop the market with someone that knows what they're doing, and I would go to a broker. Unless I've got a very vanilla request, and I'm lucky enough to still have my bank manager knocking around, and they haven't changed 10 times in the last Tuesday, and my branch isn't shut, or reducing hours, or whatever it might be. Or if I'm lucky, I get a call centre. So I've tried to talk to someone. The good thing to do is if you can talk to a human about what it is that you need and want as a business and as an entrepreneur, you are fundamentally more likely to get to the right result. The funding circle example is a great one. Availability of a debt facility is probably the most stupid thing to base your decision on. Don't do it because it's available. If it's available, that's more reason to talk to someone and say, I've got this, what do you think based on my set of circumstances, and use that as the start. That's what I reckon.
Great. Warren, anything you would like to add just on the current landscape?
Well, I have a slightly different view.
Okay.
Okay. So I think my view on it, and I've been a relationship director for many, many years. I've seen really successful businesses. I look after a lot of successful businesses. The key thing about being successful for the long term is surround yourself with brilliant people, preferably people that are more advanced in their experience than you are, and that will bring success. It seems to me that over the last 23 years that business owners often will do that with an accountant, but they don't do it with a bank manager, and I think part of that's our fault because we've got rid of some of those bank managers. We've moved up the threshold in terms of turnover when you get someone. But you'll only have a good bank manager if you support them by using their products. If you go out to the market on absolutely everything, they won't have a job at some point. So what you'll find is that when you get a good bank manager, they will know their market and they will deliver a fantastic product to you. And an example of that would be, we went up against a broker a few years ago on an asset finance deal, and it was for a printer, and it was only a small deal, probably about 100,000, and they went up, and pricing wise we were a few £100 more expensive. My asset finance lender saved that customer £3,500 because the printer was priced too high. So when you get the right people around you, you can get a better deal overall, and you can grow that business much quicker. That would be my view. But there is a market as well, brokers and with other lenders, because sometimes we won't want to do it, and a good bank manager will say, that's not for us, go and talk to someone else.
We're going into battle now. That all makes absolute sense, apart from a really, really sad thing. This really does upset me. Are you ready?
Yeah, really ready.
50% of all businesses will stop and finish their search at their bank. Now we bank we're the only challenger with a current account, so this happens to us as well. We're not immune to it by any means. But 50% of all businesses that look for funding to grow their businesses, when all of us sit here and say you guys are the backbone of the economy, yet our actions say 50% of you will start and stop your search there, there's something wrong with that. The fact that we've got all these lenders in the ecosystem, we've got really good partners in the ecosystem, we can't say yes to everything, as you've said with other security and other places, but we can't have a functioning, growing economy if 50% of businesses stop their search at their bank. That's wrong. The government tried the referral scheme, Swoop will be experts on that. It failed.
I think we probably agree on that, to be honest, because what I'm saying is go to your bank first, talk to them, but if you need top-up funding because you're not getting everything you need, or maybe they decline you, absolutely use some of these other methods.
We have to make it easier for that search to continue.
I'm very proud that I introduce people all the time because they're absolutely their heads.
No, a really, really interesting point. So I suppose just cognizant of time and with some of the great stats that Nick's been whipping out there, I don't know if anyone in the audience is in that 50% category of going to their bank and then stopping there. But I suppose now is a bit of a moment if you wanted to ask any questions with regards to funding, debt financing. Is there anything that any of the audience would like to ask?
There's no stupid questions.
Yes, please.
How do you... I'm stuck in stalemate. I own a 24,000 cement book building. I'm going to pay this so slow practice. It's absolutely useless, say it is. But I can't find funding to release the building through the community to me. I can't borrow it because I'm not in. But I've got this building that's potentially worth 3 million. Where can I get them now?
Brilliant question. I love this. We've got a live pace here, so I'll repeat that back so hopefully everyone can hear. So
It's work.
So you've got a 24,000 square foot building. You want to flip the ownership of the building into a community trust. Rent the entire building to a community company. And what you're trying to do is raise kind of debt financing against the property.
First and foremost, it sounds absolutely fantastic what you're trying to do, and helping the community is very much on our agenda as part of our ESG policy to help on the social side. But as a general point, what you just described there is not a mainstream bank deal. Okay, so in that sense, you've probably been given the right answer. Not right for you, I understand that. But what I would probably say, if I was your advisor, is there somewhere in between that you could do? So, and I don't know you specifically, so if you could... Yeah, so,
Yeah, don't do
well, my thought process was, could you split the building initially and lease out to a company half of the building or a part of the building to bring an income, borrow against that income to then support the other bit, you then lend out to the community investment company, and then when that community investment company has got a track record, it sounds like they're like a new startup, aren't they? Once they have got a record, they've got some accounts, then you can put a lease in at market rent and then probably release the whole building to the hotel.
That advice, by the way, is absolutely golden. And the bridging finance example is the example of how some of the market remains broken. It'd be an absolutely ludicrous thing to do. So don't do that. Give me a ring and we'll try and point in the right direction. That's a brilliant example. And then you try and fund the work you need to do through a lender, which is another example of why more lenders in the market need to have a higher profile through brokers and otherwise, such as Triodos, people might have heard of. That's the problem.
Bristol-based
and Unity Trust Bank. You want to try those lenders that are set up for that very purpose. Because guess what? If they can't help, you can ask a beautiful question, which is, do you know who else can? And they're in there, they live in that world. So get in contact with them via Swoop. Think of about the advice you've got here in terms of splitting that building. That's as close as you'll get to a great thing that you're trying to do.
Good luck.
Apologies that we're gone just over time, so I should have really opened up questions earlier. I need to really learn from this. That was a great question. But if you also have questions you'd like to ask any of our panel, please stick around and do ask. But thank you so much for coming in and sharing your time with us today.
Thanks for watching this special episode from the Festival of Entrepreneurs. Our mission is simple: to help founders and business owners grow faster, think bigger, and take action. And if you were part of the event, thank you for joining us and being part of the community. And if you missed it, don't worry. We'll be back with even more ideas, inspiration, and opportunities to help you take your business to the next level. You can find out more and register for future events at festivalofentrepreneurs.co.uk.